China's entire economy is on the verge of collapsing and triggering the world's largest recession. Recent Chinese economic data reveals the country's fundamental instability. The Chinese Communist Party is attempting to safeguard the Chinese economy, but the truth has already been revealed. Cathie Wood, who handles nearly $20 billion, has clearly sensed the world's inevitable suffering. Economists believe the United States' GDP growth will now surpass China's for the first time in over 5 decades. So, what exactly is going on in China? Stick around until the end of the video if you want to know the truth about China's current crisis, as well as shocking data about the country's inevitable collapse. China had extraordinary levels of growth after opening its economy in 1978. China's GDP growth rate has been around 10% every year. This brought in significant wealth for Chinese residents. Over 800 million people were lifted out of poverty. Healthcare has expanded dramatically. Education has become more important, and technological growth has skyrocketed. China's unparalleled progress has transformed the country into a manufacturing powerhouse, revered by all economists. But as we all know, there is no such thing as a paradise. The source of China's exceptional wealth is wrapped inside its increasing liabilities. When the economy was doing well, consumers who took out loans saw their net worth rise quickly. This encouraged others to jump on board, leading the economy to expand even faster. As a result, even more Chinese citizens took out loans. The cycle was a positive feedback loop that resulted in China's rapid growth. This system has worked for many decades, but China's debt has reached an unsustainable level. China's government debt to GDP ratio has risen to more than 66%, which is due to decades of expansion. The overall public Chinese debt to GDP ratio has also risen to more than 300%. This is about 60% higher than the global debt to GDP ratio, and nearly double the non-financial corporation debt to GDP in the United States. Such a vast number of liabilities is plainly problematic, and China's current problems are showing this. By the way, are you enjoying this video? Please give it a like and hit the subscribe button if you like content about the business, economy, and crypto. It really helps me grow the channel. China has been seeking to achieve a policy known as Zero COVID. The Zero COVID policy sets a basic goal of 0 COVID cases for the Chinese government. The only way to get even close to this aim is to impose strict laws with serious economic consequences. Due to strict COVID regulations, banks and economists around the world have consistently reduced their GDP forecast for China. More importantly, China's crackdown on over-leveraged companies may create the inverse of the positive feedback loop we discussed earlier, a negative feedback loop. When people default on their debts, the economy slows down. As a result, more individuals default, further slowing the economy. President Xi's objective is simple: common prosperity. He has implemented plenty of regulations to reach that goal. Real estate is one of these sectors. Real estate prices are the pinnacle of unusual success. Rising property prices have led to a disproportionate percentage of capital appreciation for speculators. Xi is trying to fight this by introducing new property taxes. The 3 red lines policy is another policy that Xi has been adopting to crack down on real estate. The 3 red lines limit the amount of debt that property developers can acquire. All of these measures are leading home values to fall at incredibly fast rates. The number of new home sales is also declining at the same time. In 23 major Chinese cities, new home sales fell by 33% in early May 2022. Real estate contributes 25% of China's GDP, so a 33% decline in home sales would result in a 9% drop in China's GDP. The Chinese government knows the approaching collapse and has done all in its power to keep it from falling further. While the US Federal Reserve has been increasing interest rates, China's government has been reducing interest rates to save its economy. The prime rate for household and corporate loans in China is now 3.7%. This figure is only projected to fall further as time passes. The government just reduced its 5-year loan prime rate by the largest since 2019. Most investors regard this disaster as an isolated event that will not influence other nations. But China's economic collapse might send the entire globe into a deep recession. The US Federal Reserve is boosting interest rates and strengthening the dollar's purchasing power. This immediately weakens the value of the Chinese yuan in comparison to the US dollar. China's sinking currency will cause its purchasing power to plummet, while the Chinese economy is already collapsing. The Fed is primarily concerned about the United States, but I believe Europe is in recession. While some of the data coming out of China is shocking, it also has an impact on the rest of Asia, so they are in a downturn and their currencies are falling. In 2021, China was responsible for more than 18% of the global GDP. So a dramatic decline in China's economy would trigger a worldwide recession. And to add the cherry on top of the cake, Europe is experiencing slow economic development. and we are in a terrible situation. Cathie Wood compared boosting interest rates to playing with fire because it might worsen global issues. The US bond curve just inverted for the first time since 2019, which also indicates that a recession is likely. An inverted yield curve is when the 10-year Treasury bond yield is less than the 2-year Treasury bond yield. When the interest rate for a shorter period of time is greater than a longer period of time, this means that the near-term risk is greater than the long-term. In a nutshell, bond investors are expecting considerable pain. An inverted yield curve typically precedes recessions most of the time. Europe and China are in a delicate situation. The Feds appear to be toying with danger. International economies are extremely unstable at the moment, and a collapse in the US economy would send every other country into an uncontrollable crisis. Europe is most likely in recession. If we look at the micro data, China is well and truly weak. And so everything depends on the United States. So supply shocks, I believe, are affecting purchasing power. And as I said in the US, a recession will swiftly remove supply chain blockages. And I believe that most of what we're experiencing right now is a result of supply chain and supply shocks, which is cyclical. And I feel we will see the other side of this. The most recent global recession occurred in 2008 when a wide range of countries faced an economic downturn. However, the 2008 recession was not on the same level as our current crisis. During the worldwide recession of 2008, China's GDP was still expanding in the double digits. Asia, Australia, and Africa similarly had no significant declines in their respective GDPs. Unlike in 2008, the bulk of Asia, Europe, South Africa, Australia, and America is in trouble. I've talked a lot about the numbers of China's economy throughout this video, but those numbers could actually be fake. China is notoriously known for faking economic data that hides economic disasters and exaggerates development. Several Chinese cities have admitted publicly to fabricating economic data. One northern industrial city in China, named Baotou, openly changed their economic report due to fake additions. Another city, called Chinese Manhattan, inflated its income by 33% in 2016. This sort of inaccurate reporting might indicate that China is already in a recession, but we aren't aware of it. Cathie believes that if we knew the true data in China, the property industry would see even more huge sale drops. She believes that this will result in reduced energy prices in the near future. I'm beginning to think that substitution as well as a recession in Europe, a significant slowdown in China. I think if we saw the real numbers there, we'd probably be seeing more declines, given how hard they've struck the property sector and are tightening the economy in general from a regulatory standpoint. So with all this information, how can investors prepare their portfolios to endure the crisis? Holding cash is a simple method to survive, but inflation will take a stab at your money. Investing internationally is clearly not an alternative, with Asia and Europe both struggling. Investing in the US market is one way to safeguard your wealth in the coming months. Although it may seem contradictory, the US financial markets are still in the best shape compared to the rest of the world. Despite the fact that the US dollar is facing severe inflation, it is still holding its value. The dollar index reflects the dollar's strength against other currencies. Despite massive inflation, this index has been on the rise for the past year. Investing in gold could be a good hedge, although the significant slowdown in inflation could lead gold prices to drop. Every asset, in my opinion, has drawbacks. Diversification in the best assets would be the best solution for minimizing volatility while maintaining positive returns in this scenario. For example, a well-diversified portfolio could be 25% in cash, 5% in gold, 5% in Bitcoin, 40% in ETFs, and 25% in individual stocks. While such a portfolio may not produce the highest returns, you will still have enough money to purchase the dip while collecting long-term gains. The dollar's value is increasing, and I believe there is a reason for it. China has become more hostile to foreign investment. Europe is in a slump and with a war on the side. And for now, the United States looks like the safer place to be. What do you think about China's looming recession? Will the United States suffer alongside China? Let me know in the comments below. If you learned something new from today's video, click the subscribe button and hit the bell icon to be the first to see my next video. I make deep dives like this every week where I uncover the secrets of money and business.